This is Meet Sean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
So imagine your house is burglarized.
Oh, awful.
Yeah, worst nightmare, right. And the thief takes, I don't know, your $1,000 flat screen TV from the living room, and then they grab your $15,000 vintage Rolex from the bedroom nightstand.
Right. Classic target.
Exactly. So when the dust finally settles and you file your claim, your standard home insurance company, they write you a check that fully replaces the television, right? And then they hand you a mere $1,500 for the Rolex.
Yep.
So you are just left completely out of pocket for the remaining, $13,500?
Yeah, it's brutal. And that scenario, that plays out thousands of times a year.
Oh, I bet.
Because people operate under this very dangerous assumption. They pay their homeowners or their renters insurance premium every month.
Right.
So they naturally just believe every single item inside those four walls is protected equally.
Yeah.
But the fundamental thesis we are unpacking today is that true protection is not just about preventing a loss. It is about your ability to definitively prove existence, value, and ownership to a financial institution whose mathematical models are basically designed to limit their exposure.
Limit their payouts, yeah. So today's deep dive is really all about those massive kind of hidden blind spots in how we protect our most concentrated pockets of wealth.
Yeah.
So specifically, we're talking about jewelry and rare collectibles. And to understand the mechanics of this, we are pulling insights from a really comprehensive guide published by SeanWillenshow.net.
Right, the Florida group.
Exactly. They are an insurance and financial solutions platform based down in Florida. And let's be honest, Florida is a state that knows a thing or two about catastrophic loss.
Oh, absolutely. They deal with it constantly.
So their research breaks down the exact differences between standard policies and specialized coverage.
Yeah.
The surprisingly rigid rules of appraisals, which we'll get into.
That part is fascinating.
Yeah, and the specific daily security protocols that basically dictate whether a claim is actually paid out or just flat out denied. So whether you are, traveling for the holidays or maybe you're inheriting some family heirlooms or you just want to make sure an engagement ring is actually protected.
Right.
This deep dive is going to prevent a massive financial headache down the road. Okay, let's unpack this.
Let's do it.
Yeah.
I think the best place to start is by dissecting why standard homeowners policies fail so spectacularly when it comes to high-value items.
Yeah. Why the big gap?
Well, it all comes down to the underlying mechanism of risk pooling.
Risk pooling.
Yeah. A standard insurance company builds its financial models around common, widespread perils. Kitchen fires, burst pipes, a tree falling on the roof.
The normal stuff.
Exactly. Yeah. They are pooling the risk of ordinary household goods across millions of customers.
Right. It's essentially a multi-tool. It's incredibly useful for basic, predictable fixes around the house,
Yes.
A broken window, a stolen laptop, maybe replacing a burned-out couch.
Yeah.
But trying to protect a $20,000 family heirloom with a standard policy, it's like trying to perform intricate surgery with a Swiss Army knife.
That is a perfect analogy.
You are just using the wrong tool for a highly concentrated risk. It's like having a flimsy umbrella in a hurricane. It just gives you the illusion of protection until you actually need it.
Exactly. And that concentration of wealth, it physically breaks their actuarial models.
How so?
Well, an insurer cannot easily calculate the risk of a single highly portable item that, holds the financial equivalent of a small car,
right,
but can be dropped down a sink drain in 2 seconds.
Oh, wow. Yeah, that's a good point.
Because they cannot accurately model that localized risk within a general pool, they have to rely on a blunt instrument to protect themselves, and that is strict payout caps.
The fine print.
Yes, that is exactly why you see limits buried in the fine print capping jewelry payouts at $1,000 or $1,500.
That is so wild. And the mechanism they use to calculate that meager payout is equally brutal. Right. Because standard policies typically rely on actual cash value.
Yes, actual cash value.
Which means they run your belongings through depreciation tables. So if you lose a 5-year-old television, they don't give you the money for a brand new one.
Right. They give you the value of a used 5-year-old TV.
Right. Which makes sense for a TV.
Yeah.
But applying that same depreciation math to, say, a vintage watch or a diamond ring,
it's absurd.
Assets that often appreciate or track with global commodity markets, that's just a massive structural flaw.
If we connect this to the bigger picture, specialized jewelry insurance, completely bypasses those depreciation tables.
Okay.
Specialized policies offer comprehensive coverage based on full market replacement value.
Replacement value, so not the actual cash value.
Correct. The insurer is contractually obligated to provide the exact amount of capital required to purchase that identical item at today's current retail prices.
Oh, wow.
And they typically structure these agreements with very low or completely zero deductibles.
Zero deductibles. That's amazing.
Yeah.
Because that foundational mismatch between, actuarial tables and luxury goods, it becomes glaringly obvious the moment you leave your house.
Oh, absolutely. The threat landscape completely changes.
Especially when we introduce travel. Or like chaotic periods like the holidays.
Yes.
You are hauling luggage through airports, navigating crowded hotel lobbies, going to parties. The risk profile just skyrockets.
It really does. And this introduces one of the most terrifying yet critical legal phrases buried in any insurance contract.
Which is?
Mysterious disappearance.
Oof. Sounds ominous.
It is. In a standard homeowner's policy, coverage is predicated on proving a specific peril occurred. You have to prove a fire burned the item, or a thief broke a window and stole it. The burden of proof is entirely on the policyholder to demonstrate the mechanism of the loss.
Which is incredibly problematic in the real world.
Very.
I mean, let's say you are at a crowded holiday gala. You take your engagement ring off to wash your hands in the restroom. You get distracted by a conversation and you walk out.
It happens all the time.
And you realize your mistake. 20 minutes later, you run back in and the ring is simply gone.
Yeah.
You didn't see anyone steal it. There is no broken glass.
Yeah.
There is no security footage of the bathroom.
Exactly.
A standard insurer looks at that lack of evidence and denies the claim because you cannot definitively prove a covered peril caused the loss. It's just a mysterious disappearance.
Exactly. But specialized policies fundamentally flip that burden of proof. They explicitly cover mysterious disappearance.
Oh, really?
Yes. The legal trigger for the payout is simply the documented absence of the item, regardless of whether you can prove a crime occurred.
Wow, that's a huge difference.
Furthermore, these policies almost always include worldwide coverage.
Okay, so a standard policy might restrict theft coverage to the physical address listed on the declaration page.
Often they do, yes.
Whereas a specialized policy covers the item whether you lose it in your own kitchen or drop it in the Mediterranean Sea while on vacation.
Exactly. Anywhere in the world.
But I have to push back a little here. I hear all these benefits, zero deductibles, full replacement value, worldwide coverage for simply losing an item.
Right.
But let's look at the bottom line. Taking out a completely separate insurance contract for a single watch or a necklace, it sounds tedious, and logically it sounds incredibly expensive.
I get that a lot.
Right. Because if an item is that easy to lose, the premium should just be astronomical.
That is the most common deterrent. People assume it's going to cost a fortune, but the economics of specialized insurance are surprisingly favorable.
Okay, what are we talking?
Annual premiums typically sit at just 1 to 2% of the item's total appraised value.
Wait, really? 1 to 2%?
Yeah,
That is actually incredibly counterintuitive.
it is, isn't it?
I mean, you would assume insuring a highly targeted, easily misplaced luxury item would cost a massive premium. But at 1 to 2%, meaning roughly what, $100 to $200 a year for a $10,000 ring?
Exactly.
The risk profile the insurer is calculating must be remarkably stable, provided the owner follows their specific security protocols, I guess.
You hit the nail on the head. The insurers know that people who take the time to acquire specialized coverage generally treat their items with a higher degree of caution.
Self-selection.
Yes. It filters out the highest risk behaviors. The research actually highlights a Benjamin Franklin quote that perfectly encapsulates this financial decision.
I love a good Franklin quote.
He said, "The bitterness of poor quality remains long after the sweetness of low price is forgotten."
That's good.
Right. Attempting to save $150 a year by relying on a home insurance cap becomes a catastrophic financial miscalculation the exact moment an heirloom disappears.
Yeah, that makes total sense. So if the math makes sense, the next variable is choosing the actual provider.
Yeah.
Because the market is saturated, and obviously a specialized contract is only as reliable as the financial institution underwriting it.
Absolutely. The fundamental metric for evaluating an insurance provider is their AM Best financial strength rating.
AM Best.
Yes. AM Best does not just look at customer service. They run intense stress tests on an insurance company's liquid capital reserves against catastrophic correlated loss models.
Okay, so like a worst case scenario test.
Exactly. If a major hurricane hits Florida, destroying thousands of homes and the jewelry inside them simultaneously, does the insurer have the cash on hand to pay every single claim without going bankrupt?
Oh, wow. I never thought about it like that. A localized disaster would trigger massive simultaneous claims.
Exactly. You want a provider with a top-tier rating to ensure your safety net actually exists when you need it.
Okay, so looking at the landscape of these providers, the guide offers some distinct architectural differences between them.
Yes, it breaks down 3 major players.
Right. First, you have Jewelers Mutual, which is a pure-play specialty firm.
Right. They underwrite absolutely nothing but jewelry, which means their entire claims department is staffed by people who intimately understand gemology and the nuances of custom repairs.
They speak the language.
Exactly. Then you have entities like Chubb.
Chubb, yeah.
And they operate in the high net worth space. Their infrastructure is designed for individuals who need to bundle luxury assets.
So like fine art collections, multiple high-end properties, and significant jewelry holdings, all under one sophisticated umbrella policy.
Right. And finally, they mention providers like State Farm, which represent the generalist approach.
Which makes sense. This is highly effective if you prefer having a localized agent relationship.
Yeah, someone you can actually go talk to.
And if you want to leverage aggressive bundling discounts by tying your jewelry policy to your auto and primary home insurance.
Exactly. But the critical variable across all these options is ensuring the contract allows you to choose your own jeweler for repairs or replacements.
Quick pause. Got a question you want covered on an upcoming episode? Use the Send Us a Text link in the show notes and tell me what you're dealing with. I read them and I pulled topics straight from your messages.
Right, because if you have a trusted family jeweler who understands the specific history of an antique piece, you cannot have the insurer forcing you into the discount repair center just to save their own bottom line.
Oh, absolutely not. That ruins the whole point.
Yeah.
So we have established the architecture of the policy itself. But a policy is merely an agreement to pay a specific amount based on a specific document.
The appraisal.
Yes. The entire financial weight of the system rests on a single piece of paper, the appraisal.
And this is where we run into a massive structural confusion, I think, between appraisal value and insurance value.
It's huge confusion.
Because people assume those two numbers are synonymous,
Yeah.
but they actually operate on completely different timelines.
Exactly. An appraisal is a financial snapshot. It perfectly captures the exact retail replacement cost of an item on the specific day the document is signed.
Right. But the global commodities market does not stand still.
No, it certainly doesn't.
Gold prices surge, diamond availability fluctuates, inflation alters retail pricing.
Right. And the insurance value is the specific maximum dollar amount your policy is legally authorized to pay out.
Oh, okay.
And that ceiling is entirely dictated by your most recent appraisal.
So if your snapshot is out of date, it basically creates a dangerous liability gap.
A huge gap.
Like if you appraised a custom platinum ring 10 years ago at $6,000, your insurance policy sets your maximum payout at $6,000.
Yes.
But if the current retail market dictates it will now cost $11,000 to recreate that exact ring today, the insurer is not obligated to cover the difference.
Got it all. Your old paperwork acts as an artificial cap, leaving you underinsured by $5,000.
Wow. Just because of old paperwork.
Yeah. So to mitigate that exposure, the industry standard mandates a strict reappraisal schedule.
How often?
The recommendation from the source is a completely fresh appraisal every 2 to 3 years.
Okay. 2 to 3 years. That's pretty frequent.
It is. And this cannot be, a casual estimate from a mall kiosk. It requires a certified gemologist, ideally one affiliated with an organization like the American Gem Society.
The AGS.
Exactly. A proper appraisal involves plotting internal inclusions, verifying metal purity, and indexing the piece against highly current commodity market data. It is a dense, legally binding diagnostic report.
Got it. But, a perfectly updated appraisal won't save you if the diamond physically falls out of the setting and washes down a drain because of basic wear and tear.
Oh, no, it won't.
So that is where daily physical security intersects with financial protection. And the primary defense mechanism is obvious, utilizing a UL-rated fireproof safe for storage.
Yes, the UL rating is critical there. UL stands for Underwriters Laboratories, and their certification means the safe has been rigorously tested against specific heat thresholds for specific durations.
It's not just a heavy metal box.
Exactly. Insurers look for that specific standardization. Furthermore, the safe must be physically bolted to the structural framing of the house.
Because an unbolted safe is essentially a convenient, heavy carrying case for a burglar.
Exactly. It makes their job easier.
Right. And demonstrating to your underwriter that you utilize a bolted, UL-rated safe can frequently result in substantial premium discounts.
Oh, yeah, because it drastically alters the localized risk profile.
Here's where it gets really interesting, though. Security goes beyond just preventing theft. It requires actively monitoring for structural failure.
Yes.
The guide outlines an incredibly simple, zero-cost maintenance protocol that I thought was brilliant. You take your ring or pendant, hold it closely to your ear, and gently pap the metal band.
The acoustic test.
Exactly. The acoustic test. If you hear a microscopic rattling sound, you have a structural emergency.
Yes, you do.
Because metal fatigues over time, right?
Yeah.
Gold and platinum are relatively soft, and daily friction slowly wears down the prongs securing the central stone.
Mm-hmm.
So that tiny rattle is literally the sound of the diamond moving loosely within the setting.
It's terrifying once you know what it is. If you catch that sound, you immediately secure the piece and take it to a jeweler. Catching a fatigued prong before it snaps is the ultimate form of proactive risk management.
Yeah, a lot cheaper to fix a prong than replace a diamond.
Absolutely. But even with meticulous appraisals, bolted safes, and daily acoustic checks, the mathematical reality is that losses still occur.
They do.
The mechanism of the loss, whether theft, fire, or mysterious disappearance, eventually forces you into the claims process.
Right. And the success of an insurance claim is almost entirely engineered before the loss ever happens.
What's fascinating here is that proactive organization is the deciding factor in claim success. When you call an adjuster to report a $15,000 loss, their immediate job is not to write a check.
Oh, definitely not.
Their job is to verify the liability. You cannot rely on a verbal description.
Right. You can't just say, it was really sparkly.
Exactly. You have to definitively prove the item existed, you have to prove you owned it, and you have to prove its physical condition prior to the loss.
So the pre-loss documentation strategy is really your primary defense against a denied claim.
It really is.
This requires high-resolution macro photography of every piece in your collection. Like, you must document the specific clasps, the exact architecture of the setting, any micro engravings or serial numbers on the band.
Yes, every detail.
Because physical documentation is incredibly vulnerable. If you store your original receipts, diamond grading lab reports, and physical appraisals in the same house as the jewelry.
Which most people do.
Right. That means a single catastrophic event, like a severe fire or a flood, destroys both the asset and the proof of the asset simultaneously.
Exactly. You lose everything at once.
So the protocol demands creating a decentralized digital vault.
Yes. Every high-resolution photo and every scanned PDF must be uploaded to a secure cloud server or saved on an encrypted external drive stored at a secondary location.
Like a safety deposit box or a relative's house.
Right. You need the ability to instantly access that undeniable proof from a laptop in a hotel room thousands of miles away.
Right, because when the loss occurs, the timeline becomes your biggest enemy.
The timeline is critical. The psychology of losing a high-value item often works against the policyholder.
Oh, I can imagine. The panic.
People panic, they fall into denial, and they spend 2 weeks tearing their house apart or calling restaurants hoping the item turns up.
Right, because you feel stupid. You don't want to admit it's gone.
Exactly. But insurers view this delay as a massive red flag and a breach of contract.
Really? Why do insurers care if you spend a week looking for it before calling them?
Well, because insurance companies rely heavily on the probability of recovery.
Okay.
Often through a legal mechanism called subrogation or through active law enforcement investigations. Every single hour that passes drops the statistical chance of recovering a stolen item exponentially.
The trail goes cold.
Exactly. The cold trail limits their options. If you suspect an item was stolen, the absolute first protocol is not calling the insurance company.
Oh, it's not?
No. It is contacting local law enforcement and filing a formal police report. Ah, okay. The police report. That's the insurer's primary filter against fraudulent claims, I'd assume.
Yes, it introduces legal stakes.
Right, because falsifying a police report is a severe crime.
Exactly. So, an adjuster knows that a claimant armed with a verified case number has crossed a significant legal threshold.
That makes a ton of sense.
Once you secure that case number, the immediate second step is officially notifying your insurance provider. You must initiate the claim within the strict window outlined in your policy to avoid an automatic denial based on delayed reporting.
Don't wait around.
Never wait.
And the final hurdle is managing the actual communication with the adjuster.
This is where people trip up.
Because people in a state of panic often make critical errors here.
Oh, yeah.
They offer shifting narratives about where they think they might have lost the item. Or worse, they let anger dictate the conversation and attempt to, verbally exaggerate the value of the piece.
Which is the worst thing you can do. An adjuster's entire job is to look for inconsistencies.
Right. Shifting stories trigger fraud investigations. The strategy is to rely entirely on your decentralized digital vault.
Just stick to the facts.
Yes.
Yeah.
You provide the police report, the high-res photos, the recently updated appraisal, and a calm, consistent narrator of the events.
Because you are entering into a transaction of trust. The insurer has the capital to make you whole, but you must hold up your end of the mathematical agreement by providing airtight documentation and adhering to the timeline.
Exactly. It's a two-way street.
So what does this all mean? When we pull all these disparate threads together, the overarching narrative is clear. Insurance is not a passive document you purchase once and forget in a filing cabinet. It is a highly active, ongoing financial strategy.
Right.
It requires understanding the severe limits of risk pooling in standard homeowners policies. It demands the discipline to secure fresh gemological appraisals every 2 to 3 years.
Right.
It involves building a decentralized digital vault of macro photography and legal documents.
Yeah.
And it requires analyzing the surprisingly affordable economics of a specialized policy so that when a catastrophic loss does occur, you are heavily insulated.
It is about engineering certainty in a highly uncertain world. You control the documentation and the physical security protocols, so you don't have to panic when the unpredictable variables finally surface.
That's incredibly empowering, honestly.
It is. And, observing this heavy reliance on digital records raises a fascinating question about the future architecture of this entire industry.
Oh, this sounds like a paradigm shift. Where is the industry heading?
Think about the current trajectory of proof.
Okay.
Right now, the entire system relies on a certified gemologist physically examining a stone, printing out a piece of paper, which we then scan and encrypt on a cloud server to prove to an adjuster that we own a specific asset.
Right, it's very manual.
But if the industry is already demanding encrypted digital records as the ultimate proof of ownership, how long will it be until physical appraisals are completely obsolete?
Oh, interesting.
Imagine a near future where the moment a diamond is cut or a vintage watch is authenticated, its entire history, physical diagnostic data, and chain of ownership are permanently minted as a digital twin on a decentralized blockchain.
Oh, wow. So instead of scrambling to locate a water-damaged receipt from 10 years ago,
Right.
or arguing with an adjuster about a recent appraisal, the asset itself is inextricably tied to an immutable digital ledger.
Exactly. That would completely eliminate the friction of proving existence.
Yeah, because the proof is built in.
If an item suffers a mysterious disappearance, the adjuster could instantly verify the blockchain record, confirm the specific inclusion plotting of the diamond, and execute the payout via a smart contract in a matter of hours, not weeks.
That is a massive evolution in how we define ownership.
It transforms trust from a piece of paper into pure, verifiable mathematics.
That is wild. Well, whether you are preparing to tie your family heirlooms to a blockchain ledger in the future, or you are just going to hold your watch up to your ear today to listen for a microscopic rattle.
Hopefully both.
Yeah. We hope this deep dive equips you with the exact strategies needed to keep your wealth secured. The ultimate goal is to ensure your most treasured items remain exactly where they belong.
Absolutely.
Keep auditing your policies, keep questioning the fine print, and never assume the multi-tool is the right choice for the job. We will catch you on the next deep dive.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.